In this lesson, how to use the stochastic indicator. The learning objectives are: you should know how to calculate the stochastic indicator, and you should know the different strategies to use to help you trade using the stochastic indicator. The stochastic indicator is a technical indicator that helps traders determine where a trend might be ending. The oscillator works on using the idea that during the uptrend, prices will remain equal to or above the previous closing price, and during a downtrend, prices will likely remain equal to or below the previous closing price. The stochastic oscillator uses a scale to measure the degree of change between prices from one closing period to predict the continuation of the current direction trend. The stochastic indicator measures the momentum of price. Momentum always changes direction before price. The stochastic indicator is a momentum indicator and it oscillates between 0 and 100. It often gives signals before there's a change in the price direction, so it's a leading indicator. The indicator works by comparing the most recent closing price of a pair to its price range over an X period of time, and then taking a moving average of the result. So the indicator has two lines. The percentage K line, which shows the position of the most recent closing price in reference to the X period range, and the percentage D line, which is a moving average of percentage K. The slower stochastic is found by taking another moving average of the result. You can adjust the sensitivity of the indicator by increasing or decreasing the value of X or the moving average. This sounds incredibly complex, so I would advise you take notes and do more research on this specific topic to truly understand it. It's very important, because although it's a simple calculation, it will allow you to tweak it to your liking and to make it fit around your strategy. The stochastic technical indicator tells us when the market is overbought or oversold. When the indicator is above the 80% line, which is here, it's said to be overbought. And when it is below the 20% line, which is here, it's oversold. We should buy when the market is oversold, and we sell when the market is overbought. But being overbought or oversold doesn't always indicate a potential price reversal. When a trend is very strong, the indicator may remain in the overbought or oversold region for a long time, so you should not blindly enter trades. Looking at this real world example, you can see that when the stochastic indicator became overbought, price did dip a bit, but as you can see, it continued going upwards. But I would say that when it did become oversold here, it did go back up, and then it dropped after being overbought. But I would say here, if you blindly entered a trade when it was oversold, you would have lost money. On this chart, the percentage D line is red and the percentage K line is blue. So a way to trade using the stochastic indicator is when the fast line crosses the slow line, you can use it as a indication of a change in price momentum and a possible price reversal. Another use is waiting until the indicator crosses the 20% line from below to confirm an upward reversal, or crosses the 80% line from above for a downward reversal. As you can see, this strategy would have worked better here if you waited until it crossed this line, better here if you waited for it to cross the oversold line, And you can just see, you can pause here, you can look at a real world example, and you can see how price reacted from crossing. Another important reversal signal is a divergence between the indicator and the price action at key price levels. If price makes a higher high and the indicator makes a lower high, there's a chance of a price reversal that's about to happen to the downside. Because here's a good example. Price was rising and it made a higher high, but the stochastic indicator had already started to fall. And as you can see, a price reversal did happen. Similarly, when a price makes a lower low, like here, and the stochastic indicator makes a higher low, the odds are in favor for an upward price reversal. Although it was small, it does still prove the point. You can look for other real world examples by using sites like TradingView.